Hey folks, welcome back to Fighting Words Financial. This video is part of my new informed investing series where I'm going to be doing a bunch of how-to videos. And in this video, we're going to talk about how to value a stock based on current earnings using the price to earnings ratio. If you like this kind of how-to content, please consider subscribing, hit the like button, and click on notifications as I'm going to be putting out more and more videos explaining how investing works at a more technical level for both beginners and experts. Also, if you want to support my work, I do have a Patreon link in the description along with links to other goodies. And of course, I do get paid a small commission if you go and buy one of those things through the links. Now, there are a couple of steps to the process of deriving a value for a stock by going through the price to earnings ratio, and I'm going to start explaining those to you right now. The first step is to understand that established companies are most commonly valued via their earnings. I say established companies because we're not talking about trying to derive a value for the latest growth stock or the hottest stock, which may be a long way from profitability, or as in the case of many recent technology stocks, even pre-revenue. Think blue chips like Microsoft, Johnson & Johnson, or Caterpillar. What I'm talking about is using net income, or also called net profit, to determine whether or not a company is undervalued or overvalued. Now, earnings is the money that is left over after a company pays all of its bills. It is that simple. Earnings is an established metric that helps people who are trying to figure out the fair value for a company. Step 2 is understanding EPS. An important financial ratio that is informed by earnings is earnings per share, or EPS. This is something that you see on every financial app or trading site when you type the ticker symbol into the search bar. You calculate earnings by share very simply by dividing the dollar amount of the earnings a company reports by the number of shares it currently has outstanding. So if we use Johnson & Johnson as an example, it has 2.29 billion shares outstanding and it's earned 15.732 billion in the past 12 months. It has a trailing earnings per share of $6.86 per share. It's called trailing because we're looking at past data, numbers that were reported in the previous 4 quarters. So $15.732 billion in earnings divided by 2.29 billion shares equals $6.80 earnings per share. Okay, great. So now we have this wonderful financial ratio, earnings per share. And let's be honest, I never met a financial ratio that I didn't like. But earnings per share doesn't mean a lot all by itself. So the next step is to apply that ratio to another super simple calculation to look at a company's earnings relative to its price, which is going to allow us to begin to make comparisons to some of its peers. To determine a company's earnings relative to its price, the most common method is to employ the price to earnings ratio. The P/E ratio is also pretty easy. It takes the stock price and divides it by the last 4 quarters of earnings, represented by that first ratio we calculated as earnings per share. For instance, if in our example above, Johnson & Johnson was currently trading at $166 a share, it would have a price to earnings ratio of 24.16. So that is $166 share price divided by $6.87 in earnings per share. That's going to give us a price to earnings ratio of 24.16. Awesome. So now we know earnings per share and the price to earnings ratio. So what can we do with those? Well, a lot of investors don't really do anything else. They simply look at that ratio and go, oh, that's really high or that's really low, without really having a way to definitively tell whether that's high or low. They believe that PE alone magically informs them of something about the value of the stock. I think it's worth taking a few extra steps. I mean, especially if you're the one risking your hard-earned money in any individual stock, which is an inherently risky proposition no matter what stock it is. It's worth it to gather more information about the value of the stock relative to its peers. Stock analysis, or equity analysis as it's also called, involves a lot of vagaries and gathering more information and making comparisons, so it doesn't hurt to do all that, and it often helps. The price to earnings ratio has been vastly oversimplified by its fans and especially financial YouTubers, but it's still a really important tool. There are 2 key factors that influence a stock's value. The first is the profitability of the underlying company. The second, which is much more slippery in my opinion, is how investors view that profitability. Earnings reports can tell you something about how well the business is performing. However, it doesn't tell you anything about how investors view that company's performance. The price to earnings ratio is a great way to view how the collective intelligence of investors views a particular company's performance, particularly in comparison to other companies in that same industry group. For example, Johnson & Johnson competitors include Bristol-Myers Squibb, Merck, Unilever, Pfizer, and Procter & Gamble. Bristol-Myers Squibb has a price-to-earnings ratio of 23.31, roughly similar to Johnson & Johnson. Merck has a much lower price-to-earnings ratio of 13.33. Unilever has a price-to-earnings ratio of 20.45. Pfizer, 9.31, and Procter & Gamble has a price-to-earnings ratio of 24.09. Now, on the surface, when compared to the low price-to-earnings companies like Merck and Pfizer, those might appear to be a better value. But as informed investors, taking those extra few steps, you are going to ask yourself why there is a difference between the price-to-earnings ratios. Enthusiasm for a particular company on the part of investors can lead to something called price-to-earnings expansion, while a lack of enthusiasm, or really just simply a lack of attention, can result in price-to-earnings contraction, a phenomenon where price-to-earnings ratios are lower than industry average or historical average for that particular company. Price-to-earnings expansion happens when investors' perceptions improve, and as a result, they're willing to pay more for a dollar's worth of earnings. Because that's at the heart of what price to earnings really is. It's a measure of how much the market is willing to pay for a dollar's worth of earnings. PDE contraction refers to a period when investors' perceptions worsen, and as a result, they are willing to pay less for a dollar's worth of earnings. For example, if the price to earnings ratio for the S&P 500 as a whole rises from 15 to 20, while overall earnings remain relatively unchanged, this is an example of price to earnings expansion. Or if price to earnings ratios rise faster than actual earnings and do for an extended period of time, as they did for the entire market during 2020 to 2021, that bull market, the entire stock market could be viewed as being in a period of price to earnings expansion. In fact, some experts estimate that the price to earnings multiple expansion from 2020 to 2021 was responsible for up to 70% of market gains in that time period, and that actual earnings increases only accounted for about 30% of overall market gain. Normally, these ratios are reversed, with 70% of market gain being a result of improved earnings and 30% as a result of price to earnings expansion. This is a very good indicator that stock markets had outrun their earnings and that a correction was imminent. So here's what I'm looking for when I use price to earnings to value a stock. Price to earnings ratios between companies in the same industry group are going to be wildly different, and each industry group, it's going to have its own price to earnings ratio as well, and you're going to need to look those up in order to compare stocks and compare industries. The average price to earnings for any company can be very different, even in the same industry, even if they're generating the same level of profit per share. In other words, two separate companies may both report a dollar's worth of earnings per share, but one stock is going to trade at 20 and another stock trades at 30. If we look at Pfizer and Merck with their deceptively low price to earnings ratios when compared to Johnson & Johnson, they may seem like a slam dunk in terms of value. They look undervalued. But this is in large part due to the consistency of earnings. Johnson & Johnson simply has more consistent earnings growth over time. The anticipation for future increases in earnings and the stability of past earnings more than justifies the increased price to earnings ratio of Johnson & Johnson, in my opinion. The market is indicating that it is more certain about the prospects of Johnson & Johnson than it is about Merck or Pfizer, and the average investor may be willing to accept a higher price to earnings ratio in order to buy its shares. On the other end of the spectrum, if investors feel that future earnings for Merck or Pfizer are going to be underwhelming or continue to be less stable than their industry peers, as a consequence, its price to earnings ratio may remain at a relatively low level. The key thing to look for is whether the current price to earnings ratio for a stock of any given company is presently high or low. And it really is incumbent upon you to determine whether or not a low price to earnings ratio for a particular company is justified, or perhaps the company is misvalued by the market. And the tricky part is that there are arbitrary cutoff levels for every industry that qualify whether something has a high price to earnings ratio or a low price to earnings ratio. And not all of the information that you need to make that determination, whether or not a company is misvalued, is going to be quantifiable or tangible. And that's kind of a problem for me. I'm a tangible kind of person. Apple, for me, is probably the best example of a company that comes to mind when I think of something about it that's intangible and unquantifiable, which is the factor of brand. Brand should have affected my perceptions of Apple's value relative to its peers more profoundly when I was making my initial investments in this company and considering how much to sink into it. As a result, I undervalued Apple and underallocated my investment portfolio to this company in the past, and I missed out on some gains. So the best way to assess a company's price to earnings based purely on its cash flow is by comparing the price to earnings ratio to the history of the company's own price to earnings range, number one. Second is to compare the company's current price to earnings to that of similar companies. In general, if the current price to earnings ratio is at the lower end of the company's own historical price to earnings ratio, or if the current company's current price to earnings ratio is below the average price to earnings of similar companies, it may be a sign that regardless of recent business performance, the stock is perhaps undervalued. So here's what to look out for. Are low price to earnings stocks really a bargain? And that is a big question today. With computerized stock screening and tens of millions more investors involved in investing than the era when all of these metrics and terms were defined, low price to earnings stocks have been mispriced by the market less and less frequently, and they're becoming increasingly rare. In the past, investors had to manually scroll through physical pages of stock tables to discover companies with low price to earnings ratios that might be neglected or mispriced by the market. Today, simply punching a few buttons on your mobile device will give you a long list of low price to earnings companies for any industry, and you can sort it any way you like. This capability has added efficiency to the market, making it less likely for the market to misprice a stock, in my opinion. It's not really my opinion, that's something that's quantifiable. So when you see a low price earnings stock today, it often deserves that metric because of its questionable future prospects, and it may or may not represent value at all. Simply put, that low price earnings ratio may well be justified. Many times a company has a low price earnings ratio simply because its future earnings prospects are pretty dim, and that stock may not rebound in any meaningful way until investors perceive there to be some sort of catalyst for the company to do so. Now, this is particularly true of any company that is required to sink a large portion of its revenues into research and development with no certainty that these investments in research are going to pay off. The pharma industry is a great example of this because of FDA approvals and all that. It can ruin billions of dollars of research. This can create a value trap where a stock looks cheap by comparison, but the performance of the stock demonstrates over time that there was a reason that it was cheap. The best case scenario for any stock that is beyond the small cap unicorn stage is for the underlying company to consistently grow its earnings, for investors to become increasingly enthusiastic about the company's long-term prospects, and to value its earnings at a high level with an above average price to earnings ratio. But even in that ideal case, stocks are going to be overbought and oversold, even by professionals. Even professionals do this on an emotional basis. Emotional buying and selling at the extremes can force stocks momentarily into overbought or oversold territory, creating opportunities to identify undervalued or overvalued stocks. As an established company's stock price rises, investors really need to pay close attention to when a stock gets bid up to an excessively high price to earnings level. In the heat of the bull market, it is not uncommon to find hot stocks trading at PEs well above their industry average. In the last bull market, some industries, entire industries, were trading at 60 times earnings or more. This can go on for some time, but not forever. Eventually, the stock price is going to drop. And when that hot stock starts to crash, it can feel like jumping out of an airplane. Price declines can be swift and really painful. So a quick note here, remember that price to earnings doesn't tell us anything about how to value pre-profit so-called growth companies. there is no price to earnings ratio for these companies because there is no earnings and therefore nothing to put into the denominator to calculate price to earnings. Those companies must be valued in a very different manner, and in my opinion, those valuations are on a lot less solid footing. So in the next 2 videos in this series, I'm going to look a little bit further into individual stock valuation, and we're going to confirm a company's real value by applying some other valuation techniques. Those are going to be the price to earnings growth ratio and the year ahead price to earnings growth ratio. Well, folks, that's it for today's video. I want to thank you for watching, and please like and subscribe if you haven't done so already, and check out my Patreon if you get a chance. I'd love to see you in the Discord chat. I'll see you next time.